there's been a lot of software funds that have been very successful, and here's that data, right? And then there's a lot of healthcare funds as well, which I pulled and done research on, that have also delivered performance on par or maybe even exceeding software funds, right? So, diversification potentially is the only free lunch, right, in investing. So why wouldn't we want to diversify from a fully software portfolio to software plus healthcare if we believe that, right, like those are two different, pieces of, or it could be two different pieces of a portfolio that generate, uncorrelated returns.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Today, I have the pleasure of having someone with the world's coolest name join us, the amazing Winter Mead, and that's MEAD, alcohol made from fermented honey, Mead, which also happens to be my Christmas beverage of choice. Although at the time of this recording, we are a little bit far from Christmas. In fact, we're closer to the Christmas that just passed than the Christmas ahead. But all that aside, Winter is the founder and managing partner at Coolwater Capital, a fund of funds dedicated to helping launch, build, and scale the greatest emerging managers. I've had many a friend go through your programs and say that the company you grow with is honestly second to none. And outside of Coolwater, he is best known for being the author of How to Raise a Venture Capital Fund, the Essential Guide of Fundraising and Understanding Limited Partners, which is a book I too have recommended many an emerging manager and many an emerging LP. It is a 4.7 out of 5 rating on Audible and has been reviewed as the Venture Deals for Emerging Managers. For those unfamiliar with Venture Deals, that is the venture Bible written by the legendary Brad Feld. Not only that, Winter's new book is coming out soon as the follow-up to his first. His new book, titled How to Set Up a Venture Capital Fund, a quick start guide to launch your VC fund right now and prepare for institutional scale and success. And that comes from his experience across, I want to say, backing and helping 175 emerging managers. And for those curious, we'll include the link in the show notes as well. Prior to Coolwater, Winter spent time as an LP at both Hull Capital Partners and Sapphire Ventures, the latter of which where he started #OpenLP, along with our amazing season 1 guest, Beezer Clarkson. He's also the co-founder of Mead and Meads, along with his sister. We'll dive into that a little bit more in the episode. And Winter, we have a lot to cover today, but boy, I'm glad you are here. Welcome to the show.
Thanks for hosting.
So, in the process of doing homework for this conversation, I found that this is about circa 2011, 2012. You once biked across Spain with a flask of maple syrup in your back pocket. I just want to verify if that was true or what happened there.
Yeah, so that is true. I don't recommend it. You usually want like ramen, something that's very light. You don't want to bike or run long distances with maple syrup. But I love maple syrup. This was I did the Camino de Santiago, which is a pilgrimage with a friend. Mm-hmm. And most people walk it. And the interesting thing about the Camino is there's not one way. It's like everyone takes their own journey, mm-hmm. which is kind of cool. Like if you looked at it, like if you've ever looked at a picture of the Amazon River, right? People are like, oh, the Amazon. It's like, yeah, the Amazon. Like there's a lot of different options. The same thing with the Camino. Like there's a lot of different options to get to the actual, like it ends at a church. Mm-hmm. But it's for us and for my buddy, like it was a pretty interesting experience, but we had limited time because we were both working full time. So we're like, okay, how do we fit this in? We can't walk for 2 months. How do we do it in like a week? Right. And so it was a big push and we needed a lot of calories, and that's when maple syrup entered the equation.
That's amazing. I know people like when they run marathons, they have those, I don't know what they're called. I don't run marathons clearly, but like they have these pouches of like, just calories that they consume throughout to help them sustain that marathon run. I assume that the concept is similar. Yes, the goo. Yeah. Like I assume the concept is similar when you're like biking across a whole country.
Yeah. You can't you can't persist just on maple syrup, right? Like it's too sugary. You definitely need like salt. You definitely need like actual substance, but you can use it to like flavor things, right? But no, we were definitely eating ice cream, eating big meals, chowing down lots of salad. Trying to figure out other ways to have a little bit more of a balanced diet. So it was more just like I like maple syrup and I like the taste of it.
You grew up with maple syrup, so
yeah, that's funny to track that down. Yeah, haven't thought of that in a while, but
there will be. Let's put it this way. There will be many situations when I ask about maple syrup, but I would like to invoke the name Amy Lichorat. And my question is, like, how did you first meet her, and what was her significance in your life?
I owe so much to Amy. Thank you, Amy. If you're listening, I'm going to send you this pod, and you can share it with all your private equity friends. So she's great. Yeah. So she was the one that tipped me off to the role at Hall. She was at the time girlfriend, now wife of a good friend from childhood. And he, I got introduced to her through him. And then she moved out to San Francisco. She started working for Hall herself, so predates me. And a position opened up on the private equity team there, and she flagged it and said like, hey, like, I know you've done some stuff in this world before, right? Like through internships and whatnot. Yeah, any interest in like applying? And we liked hanging out with each other. So, I was fortunate. One thing led to another there, went through the interview process and, got the job. And then Hall was really like the training ground for me becoming an LP.
So I want to like take our foot off the gas pedal. I know we're at the beginning, but I want to take a foot off the gas pedal for just a sec. You said one thing led to another. You went through the interview process. There is a lot of context, story, inflection points just in those few words. Could you what was the interview process like, if you remember?
Yeah. So I think for the audience, like, how do you become an LP? My background was doing a couple of different internships and projects in finance before I joined Hall. So my transition, that step was actually quite large because I was working at a tech startup, and then I jumped over to a effectively wealth management firm or multifamily office. And so that's a pretty big jump. Not crazy, because they're, if you know Hall, like, they have a focus on technology enabled and software investing, especially in the private equity realm. And so again, it kind of almost helped to have that San Francisco, Bay Area, Silicon Valley technology mindset and perspective to then like join the investment team. But the one thing led to another. That was more the interview process, asking questions more about finance, business, investing. And again, before that, it wasn't kind of de novo for me. Fortunately, I had done a few different projects. One was working at an investment bank in South America during undergrad. Two was working at a public equities research firm in undergrad. And three was going to business school, doing a research program there. Going to business school in England, and actually doing a kind of a deeper dive investment project while I was at Oxford with the London School of Economics. So there were a few kind of things that I could talk to at the time that were finance or investment related. Again, it wasn't private equity. At the investment bank, I ended up working more on like a strategy team doing fixed income. And then at the wealth management firm in New York, I was doing more public equities research, which was helpful from a research perspective because I was joining the research investment team. And then from the LSE standpoint, it was more like just doing research and pulling together a lot of like unstructured data, which if you're an analyst at a firm, like, is probably a helpful skill set to have. So again, I was working at a tech startup, which it seems kind of an odd shift to go from tech startup to multifamily office. But for me, I think I was able to have more open, direct conversations around like what could I contribute on day one to the team and really hit the ground running. I think that that was important. And then the people over at Hall are just great. So I just really enjoyed my time there. And, some of them who aren't there anymore have gone on to do really great things. And many of them are still there. So testament to what Katie's built.
In the hallowed halls of Hall Capital Partners, I'm curious, what you mentioned the team was really special. What made the team special in your mind? Was it the construction of different mines? Was it what people were focusing on? Were they just early? They were very early to venture as a whole as well, but what made it special?
Yeah. Well, Amy, right? Let's not lose the point of the story.
Yes.
Amy made it special. Thank you, Amy. But there are some really smart folks, right? So how do you institutionally train as an LP, right? Coolwater is all about institutionally training GPs, right? But I think the point of this pod is the institutional training of the LP. I think Hall is a really good place for that, to really understand multi-asset class perspective, right? What are the different return drivers across asset classes? It's really interesting just learning from really smart people who've been successful investing on the LP side within the endowment model style of investing. So, right, if we think through kind of people that have been leading the investment team at Hall over time, right? They've worked for the Princeton Endowment, the Stanford Endowment, right? The Princeton Endowment was kind of I don't know if I call it a spinoff, but right, had a lot of influence from the Yale Endowment, which pioneered the endowment model style of investing, which is kind of the traditional approach to manager selection and, investing through managers to get allocation into alternatives. And so again, it's a really good training ground for understanding that model. What does investing like an institutional LP mean? Mm-hmm. But you're learning from people across different asset classes, which was really fascinating. So, the training ground part of it wasn't just siloed inside of a private equity team and doing, VC growth and buyout investments, but it was having a conversation weekly, if not more, across okay, where is the state of the market at a macro level, and how should we invest into this market at a macro level, right? Where sometimes, we're both in VC, I'd say sometimes the acute focus on just VC or just Silicon Valley. I think when people say your mindset's in the bubble, Silicon Valley is a bubble, sometimes you don't think about the bigger picture, right? I think you do over time, especially if you're building, Coolwater's approach, if you're building an investment firm, you as the founder of that firm probably should have a perspective. You need to be really dialed in and obsessed about venture, but you should have a perspective on, what else is going on in the world, especially with respect to other asset classes and how LPs, are making their dollars and investing at the current point in time. So Hall, again, was a really good place to kind of learn that multi-asset class perspective.
I'm curious, was there anything that Hall did structurally to help promote conversation across different asset classes? Were there just Monday partnership meetings where everyone would get together and talk, or was it just water cooler conversations?
It was both. There was definitely structure, as you're saying, but then the water cooler and the open floor approach, which is something that I continue to promote even when there was the option for offices at Sapphire. I wanted to sit on the open floor just because you just learn so much more, right? From everyone there. Right? And then it was a little bit, there was some strain at times where, especially if you're a louder talker and you're going through an interrogation of a GP as the LP, and it's 2-hour long phone call on an open floor where you're okay, I think you got all your answers. Trying to write an investment memo over here. So no, but it was, I think that actually, it was, again, it kind of contributed to, that's how real assets is kind of working, right? Or that's what's going on kind of the public equities part of the firm right now. Or, that's kind of how the state of the energy market is. And, that's kind of what they're doing in real estate now. And So yeah, it's water cooler, but it's also just the open floor approach, more of like an office design question. Again, sometimes, when you have to write, you have a deadline for an investment memo, you want some quiet time, but I actually think that office culture, open floor, structured sharing of what everyone's working on was an effective way to really learn the different asset classes, but also understand like why your asset class is so special and important, and like really kind of force the conversation around like, you're an LP, you're trying to allocate capital into opportunities that, the interesting part isn't allocating capital. The interesting part is like getting a return on that capital. And so really forcing the thinking around like, how do I make money allocating this capital, and not just like, oh, this is cool, let me put some dollars to it.
That makes a lot of sense. I'm going to scratch my own itch for a second here. You mentioned office design, and let's play fortune telling for a little bit. And so let's say Coolwater 10 years from down the road, you've grown to a team of, I don't know, 30, 40, you name it kind of thing. And you're setting up your office for the first time. You're just building a brand new office for the Coolwater team. How would you design that office? Would you put the kitchen in the middle, water coolers in the middle of the office? Would you have a multi-floored, like, given your experience at Hall as well as Sapphire, and given your love for open office space, like, do you have any intentionality behind office design?
Haven't really thought about it. It'd probably be a large round table where everyone was facing inwards just so they could talk to each other. No, I'm just joking.
Knights of the Round Table, King Arthur, let's come back.
The table just keeps getting bigger and bigger. There's 140 people sitting around a round table with megaphones shouting across each other. No, I would, in all seriousness, I'd probably design it for the community.
Okay.
So I think about kind of, if it's, 40 people, how do the different groups interrelate? And again, probably a little bit more around just like who's going to be talking the most and who may need some kind of quiet space. Like I've been into some co-working spaces that don't have like these rooms that you could just jump into and, shout on the phone. So it'd probably be some of that where you can actually dip out if you need to, be a little bit louder or be a little bit more discreet in a conversation. And then, design it for the community. So Coolwater's become a pretty large community with, a lot of funds and a lot of underlying companies. And so having a space to like a really like an open space for people to come and just jam on different things, right? Like I think we're pretty focused, but also can be pretty creative. I think people really get a lot out of the Coolwater program by us not giving them like, a single recipe, but kind of thinking through, okay, what's the best recipe here, and being willing to whiteboard and kind of figure out and like, stress test, like what is the best solution. When someone's building a firm, it's not a one size fits all fun in the box approach, right? It's very much, sometimes a bespoke approach to building a unique firm that's differentiated and really kind of, stands out to LPs. And so I think like we'd want that creative space as well, where the feel like having it too corporate or, not enough opportunity to kind of do that 20% time, I think would be a disadvantage for the company as a whole.
I agree. Speaking of just collaborative spaces in general, I was chatting with 2 days ago. I was chatting with a friend of mine. We were at a co-working space, which for those who are based in the Bay Area may know, may not know. But it's a space in Menlo Park called Canopy. And the reason why that stands a cut above the rest, at least in our discussion with my friend of mine, is that the environment is very social by design. Also happens to have a bunch of emerging managers and LPs who co-work out of that space as well. Winter, when you're back in the Bay Area, I would highly recommend co-working in Canopy. But nevertheless, it's a design where people are very social with each other. And the lack of, well, there's still offices, don't get me wrong, but the lack of office space in the center of the room and most of the room, and as soon as you walk in, it's all like lobby space and open space as well, has a lot of people chatting with each other. And that formulates a lot of opinions, and obviously that engineers serendipity in a way where GPs start chatting with each other, community members start chatting with each other. So that's what it reminds me of. But
yeah, I think there's a balance. Like, I think like the way the world's evolved over the last 5 years, maybe getting a little too philosophical, but I feel like the way the world's evolved, like people are lonelier.
Yeah. Right.
And so there's more of like, what is that community space? And I also think there's another, so I think that's a key piece, and the Canopy sounds like they're solving that in a way. But I also think there's like, you're building a company. It's so hard to build a company. It takes so many hours. You have to be so focused for so long, right? Which is lonely. But like you're right. And you want a place where you can focus, right? And just get stuff done.
Yeah.
Right. And without offending people, right? You're like, hey, I've got to work 20 hours today, right? Like I can't hang out today. But again, like having that mind space, like the opportunity to actually, like you're saying, like share ideas or iterate, or like, it's the writer's block version of being an entrepreneur, right? Like, oh man, like how do I figure out this next thing, right? Like, and there's no one to kind of jam on it with, especially in the early days. But yeah, like maybe Canopy is the place, but yeah, office design for that could be great, because then you have the ability to like, say, hey, I've got to be super disciplined as a founder and build, but also the opportunity to say like, actually, I'm stuck right now. I need to figure something out. And there's a space you can kind of jump out to that isn't necessarily in your basement office alone, 1,000 miles away from the nearest person that knows, any idea about what you're talking about. I think like there's the remote work of today's world has maybe impeded innovation, right? That's a little bit of getting into dangerous territory there, but
yeah.
I think innovation is driven off of like idea sharing, networking, right? The serendipity of like talking to other people that know what you're talking about and can like help you actually solve your problem. Mainly being biased like within technology and building software and like building a company. I think that's what's like really, really interesting. I think those community spaces like Canopy, like those spaces, like I think almost need to require that for like the sake of innovation, like that ability to like talk to other people, do the water cooler conversations and share ideas.
There's also an element of this where I think Canopy, whether intentional or not, just pick the right people, pick social individuals, where social individuals self-selected themselves into this. And I'm not saying that people just don't work and they just talk all the time, but there are like out of co-working there a couple times. It's just so easy for someone to walk by. It's like, hey, David, can I borrow 2 minutes of your time? Like, Winter, like, I just had a problem and I thought you'd be the expert on it. Do you have 5 minutes later today just to chat about something? And those are very serendipitous conversations. That's hard to do in my current man cave that I'm in right now.
Yeah. I agree.
So you did mention, staying thousands of miles from the nearest person who speaks the venture lingo. And that sounds like it comes from a lot of personal experience as well. So it kind of bleeds nicely into my next question, which is, from growing up on a farm 5 miles out of a city with a population of 2,000 to spending 7 years in the San Francisco Bay Area, which kickstarted by like a few months of sleeping on your sister's couch, if I did my homework correctly, to building a family out in Salt Lake City now. What are the pros and cons of living in the big city life surrounded by tech and interesting talk, to living in an area where you're hundreds of miles, if not thousands of miles, from the nearest whisper of early stage investing or technology investing?
Well, let's be clear for the audience that remark was more towards the remote work than my current situation. But to answer, I knew you're going to go there too. So I was like, I said that, and I was like, you're probably going to think you're thinking, I'm like saying that about myself. But no, it's more thinking about like other people I've known that have really moved out to remote towns. I think Salt Lake's a great place for, easily a top 10, if not greater, city for technology development. A lot of smart people here. Yeah, I spent 12 years in the Bay Area. I still go back almost monthly, right, to just make sure I know what's going on, given it's the greatest tech ecosystem in the world still, right? That's what the data continues to show, and it really hasn't lost its edge. It was close to losing its edge, like in terms of like just sheer amount of dollars, maybe a couple of years ago, with respect to, the investments and the quantum of investments in China, right, which is also like a formidable, tech ecosystem. But, the Bay Area is just exceptional culture, right? And being able to kind of work there, really changed my perspective. And I think I was saying this the other day, I do think I would encourage it even for LPs that want to invest into technology, right? To spend some time there. And I'm not saying dip in for an annual meeting, but really whatever the stint is of a 6-month, 12-month, multi-year, really kind of embodying that culture of the Bay Area, which is this growth mindset. And you can still tap into it, right? And still find people that are non-zero sum. And I think understanding that cultural element of venture is very important as an LP. So I felt that, that was different and something I definitely learned by being in the Bay Area. It wasn't something I learned by going to school in England, or even, I thought I would learn it in Boston, but I didn't. Maybe I was just too young at the time. And something you definitely don't learn beating down ferns on the farm as a kid.
I'm curious, you spent 12 years here, and obviously both you and I have a soft spot for the Bay Area. I'm currently in the Bay Area, and then you spent a long time in the Bay Area. Are there, for those LPs who have been motivated by what you just said and decided hey, you know what, I'm going to spend 6 months, 12 months in the Bay Area, what do you think are pockets in the Bay Area where there's a higher likelihood for serendipity to come out, right? So I'll buy you some time. What I'm thinking about when you said that was largely Blue Bottle and South Park. South Park happens to be this amalgamation of a bunch of venture funds, and General Catalyst is out there, and a bunch of others as well. And I believe Sapphire's office is probably really close to there as well. But the Blue Bottle, I would say probably 50% of folks who walk in that Blue Bottle happen to be entrepreneurs, 25% happen to be investors, and just by you being in the midst of everything helps you just see and hear things that you wouldn't otherwise if you weren't based in the Bay. But are there any other spots in your mind that LP should probably hang around?
Yeah. If you're that entrepreneurial of an LP and you're going to be doing that type of stuff, just reach out to me. We should hang. That sounds awesome. That sounds like awesome LP behavior.
Yeah.
Have I seen that a ton? I haven't seen a lot of LPs just chilling, hanging out, talking to startup founders. That would be awesome. And I'd love to talk to you if that's what you're doing. But my cheat sheet early on was meetup.com, right? Or finding these places that, and again, if you don't really know what you like, try a little bit of everything, right? Get the buffet. And so that's kind of what I did early on. And then it was there's so many events always going on. If you just kind of get on the right listservs, that's probably the homework. That's kind of what you need to do up front to get on some of these right lists. And then it's okay, great. There's 10 events going on every day. So you kind of have to kind of force yourself into thinking, well, what do I actually like and where should I actually be spending time? If you're an LP doing this, you probably have a mandate. What's your mandate? How do you need to invest? And how do you get smarter at investing, vis-a-vis your mandate? That's probably what kind of, determines where you hang out and who you hang out with. But there's so much to offer, right? So many, that was my experience, and maybe because I was just super deep in it, but there's so many events every day to do, where it's almost you can go too wide and not deep enough on any particular topic to actually give you an informed perspective on making investment decisions. Yeah, I think for me it was dating myself with the meetup, but these types of events, the right listservs. I helped teach at Stanford for a number of years. Just being on that campus, right, is another cheat sheet. Or going over to Berkeley, right? There's so many people so many students, undergrad and grad, that are just immersed into this culture of startup growth and technology growth and building companies and, being an investor, being a VC. That's another really great place. And again, those are international brands, right? So you just have so many amazing people on campus, probably every day, right? That the campuses are hosting really amazing people. So yeah, if you're in the Bay Area, and you're hanging out and trying to like really understand, technology, there's definitely some places you can spend. Coupa Cafe, Blue Bottle, knocking on doors of startup offices and, asking the tough questions. How are your VCs? How are your board members?
It might take a couple of drinks before they open up to that.
Take
but
this
yes,
10-question survey. Yeah, you don't know me. You may not know what an LP is, but I wanted to ask 10 very pointed questions about your board members.
And I promise I'm not part of the U.S. Census Bureau. That you're completely right. Like, Coupa Cafe, Blue Bottle, they're amazing spots. A lot of, founders have a lot of office space around like the South Park, Soma financial district area as well. And a lot of it in like, I've seen recently in like Noe Valley and San Francisco. But to add on to that comment of just like listservs in general, obviously there's meetup.com. I don't use it nearly as much. So Winter, you might have to educate me in like which meetups are probably most prudent or for kind of LPs. But I do know a good friend of mine runs like SFIRL, the newsletter, IRL standing for in real life. Jonathan Chang runs this amazing thing where he just picks like the top events, tech events, VC events in the Bay Area, and he puts it out, I think, every single week. Jonathan, if you're listening to this and it's not every single week, I'm sorry. And if I've put those words in your mouth and now you have to do it every single week, I'm sorry, but I'm also glad you're doing that. But at the same time, you're right. Like Stanford, Berkeley, for example, the House Fund in Berkeley runs a phenomenal class and a speaker series. Jeremy Fiance and the team out there. And you can just pop by and it's like really close to Berkeley campus. On the flip side, my partner in crime, like Ravi Balani here at Alchemist Accelerator, he teaches the largest entrepreneurship class in Stanford. And if you ever want to like just tune into like, how VCs and founders and people in the ecosystem talk and, what that looks like on a weekly basis, like hit me up or hit Ravi up. And I'm sure like we'll find some way to squeeze you in. So there's all these other avenues, but I just wanted to make it a little bit more tactical. And thank you for mentioning like Coupa Cafe and Blue Bottle, because these are great spots to hang at.
Yeah. And if you go a little bit deeper, like I'm not going to name names, but there are some like houses, right, with up to dozens of people like that are kind of like these private co-working spaces of, great engineers and angel investors. So there's that too. Like again, it feels like you can peel back a lot of layers of the onion in the Bay Area and find some really, really interesting places. And again, there's a lot of different networks. So, I think it's being focused around like, do you want to go deep on, what, right? Like what's your theme? Do you want to go deep on which industry? Like, what's your industry of choice? Do you want to go deep on like what stage, right? Is it early stage or late stage? Do you want to go deep on technology? Probably, but like, is there something else, right? Like that you're, industrial or maritime or something else that isn't necessarily like fully, technology focused. So again, like those are decisions you'll have to make up front so you can like focus your time more.
Yeah. All right, Winter, I want to switch gears a little bit over here. I'm curious because you've done a lot, right? You've done a lot as a capital allocator, obviously as an LP, but also as an angel investor. So I'm curious, as someone who's, and correct me if I'm wrong on the number, but last I heard you did 79 institutional investments and over 25 angel investments. Could you share the poetic dichotomy between being an individual angel versus being a capital allocator?
Yeah, it's a different process. I think for the institutional investments, right? The interesting exercise is the robustness of the process and really fully understanding kind of, the risks you're fully assuming. As an angel investor, I just assume I'm taking a lot of risk. As an institutional investor, you kind of want to like really know and, write about and have, your whole team really understand like all the risks you're taking. And you're kind of debating those risks of whether or not that makes sense to put into a portfolio. And you're, trying to do research on each of those risks to like make sure you at least understand them so you can potentially help mitigate them. Like it's just a different process. It's a much more thorough, robust process if you're doing an institutional investment, at least in my experience, than if you're writing an angel investment, which again, if you're an angel investor and you're trying to get back to, building a fund, right? Coolwater helps launch funds. So we see a lot of angel investors. They've made 20, 50, sometimes more 75 investments into angel deals, like as an angel. And so, and then they're kind of transitioning to become a fund manager. So I've seen kind of two approaches there. And like, this is kind of, what I've seen generally, and then I can also talk about it personally. But what I've seen generally is, like you're usually investing into just like what you think is talented, sometimes without like what talent is, before you even kind of have a thesis, right? Like where you think, you should be spending your time and investing your money. Like angel investors kind of, I think, are looking to just intersect with amazing teams. Like if this is early stage angel investing, and that's kind of how I think, I approached it after I left Sapphire, which was, who do I think is a really interesting team? Do I think they're doing something that's like accretive to the market? I'd like to support that. And like, do I think there's upside there as well? Like I'd like to support those opportunities as an angel. But I think the other approach, like, this is more for GPs than for LPs, but if you're thinking about like becoming a fund manager, right? It's what's the point of all those angel investments? Because if you have like I said, like what's the point of you, Mr. or Mrs. like entrepreneurial LP, going to the Bay Area and doing like, 1,000 like meetup startup events? Like it's kind of what's the point of your angel portfolio? I think you kind of have to, for me, like having some, reason and like rhyme to what you're doing is helpful. And that could be like, oh, I just like fintech. I just like AI. I just like really believing that this like founding team is going to like completely create a new market opportunity. Like I completely only bet on, opportunities in the construction industry, right? So I think you have to force your thinking a little bit as an angel, which is kind of fun. Like, and that's where I think it starts to relate back to institutional investing, because institutional investing is such an intellectual exercise, and angel investing sometimes can be so gut and so instinctive and so impetuous that, connecting those two for me is kind of the interesting piece. But I've also seen like the people that kind of do that kind of tie it back to a theme, and they kind of like, they have a strategy around their angel investing. Those are the most successful people at actually like taking that to the next level and actually like getting a fund off the ground. So I know I tried to like combine both like, what do I see generally in the market, but also like in terms of like what I do. But for me, I think, I had two camps. I had the camp of like, I want to support innovation. I want to support the venture capital ecosystem. If I could, in some small part, play a part, in some small way, play a part of like supporting these companies. Even if I didn't think there was like 100x upside, I would do that. But then the other angel part is like, is this a huge opportunity? Like, how has no one thought about this before? Is there the probability that this could actually happen and be big? And fortunately, like that actually has played out a couple times. So I think that's an interesting exercise in its own right, but definitely not institutional investing. I feel like they're very much two different games.
I'm curious, you said you had two different pathways when it comes to angel investing. One was just, I want to support the venture ecosystem, may not be the 100x return, but I just want to like pay it forward effectively. And the other side is you're swinging for the fences. This is going to like revolutionize the industry and whatever they're building at. How does the decision-making framework change? Like specifically for like, if you're going to invest a few dollars into, something that pays it forward, so to speak, what does that look like? Are you pretty liberal with those kinds of checks, or do you still have a decision-making framework for that as well?
Yeah, my decision-making framework, I don't know if I'm liberal with any checks, but the point there being like, I have like a decision-making framework probably behind like everything.
Yeah.
That's what I mean by that. The way I've thought about that, again, it's not like investing can be dangerous, right? Like you don't want to gamble. Like you could lose a lot of money if you gamble.
Yeah.
Right. I think investing should be thought of as a probability exercise. I still think like when I'm doing those checks, it's more founder relationship. And is this something I've thought of before? And primarily those are like, at least in my own angel portfolio, like financial technology investments. because like, I think this thing should exist in the market, right? And I just don't have the time to build it, right? Or maybe not even the talent to build it. And then you see someone else doing it and you're like, I've thought of this before, right? And I think this is a really good idea. I might be wrong, but someone else has like alignment with me. Is this going to be like the biggest outcome? Maybe not. But again, like there's probably very few opportunities in the market where any VC thinks there's going to be like $100 billion outcome.
Yeah.
Right. Like you're delusional if you think every single deal you do is going to be like that big of an outcome. So I don't think that's like too far off from like how just VCs think generally. But like, me as an angel investor personally, it's like, okay, I've thought about this idea probably already. I know this is a problem. This problem should be solved. This startup is solving it. That's kind of how I invest on that. And then like, I'm doing it to support the founder early. And then the other one is just like more of a team market, like founder market. Like this, I do actually think can be like a huge opportunity. And that's a more like generalist approach, right? And so again, I'm not the most prolific angel investor in the world. So I would take everything I say with a huge grain of salt. But I think maybe the point here is if you're an LP and you're thinking about like investment decision-making frameworks, right? Like, do you have one? Right? And do you have one across everything you invest into?
Yeah.
Right. I really think you should always, as an LP, like challenge the how does this work? Why am I investing? Do I know how this makes money? Right? Like really kind of force the thinking on like why you're making a bet.
To double down on that, would it be possible for us to go through a tactical exercise of like how an LP might think about, let's say, allocating into a certain industry, whether it's fintech or AI or
we can try it.
In the sense, like, what are the questions they should be asking themselves to get there?
So let me think. Here's kind of how I'll give you an example. I'll kind of abstract it a little bit. But there's kind of a few different things you're managing if you're an LP, right? So this will probably come across as obvious, but I'll try to abstract it and generalize it in a way so it's not necessarily obvious like who or what I'm talking about. I won't use names, but working at an LP firm, you want to develop a new like a new thesis, right? Like you have a mandate. The mandate maybe is more general, like I need to invest into early stage venture. But let's say you've never done healthcare before. So, okay, well, I now have decided, at least personally, but the whole team, right? Like this is a team decision. I've decided like, I think it would be really interesting to invest into healthcare. Why would you invest into healthcare? How would you invest into healthcare? Like, is there even healthcare in early stage, right? Like, there's like, so some of those are like obvious, like, of course there is.
Yeah.
But then it's like, okay, now I actually need to sell it internally, even though my mandate is more general, like invest in early stage. It's like, hey, we've never done a healthcare investment before. So what is the process if you're an LP working at a bigger firm, especially, what is the process to actually like convince your team members that there's a really interesting opportunity here? And so, one way to do that, that's very convincing is, performance data, right? And saying like, hey, look, there's been a lot of software funds, like let's just use we're investing in the funds perspective. There's been a lot of software funds that have been very successful. And here's that data, right? And then there's a lot of healthcare funds as well, which I pulled and done research on, that have also delivered performance on par or maybe even exceeding software funds, right? So, diversification potentially is the only free lunch, right, in investing. So why wouldn't we want to diversify from a fully software portfolio to software plus healthcare if we believe that, right, like those are two different, pieces of, or it could be two different pieces of a portfolio that generate, uncorrelated returns. And so I think so you're kind of demonstrating it first through the tactical pieces, like how, like identifying the area first, understanding what actually moves the needle, which is like data and performance. pulling that together in a research project and like delivering that as a presentation, right, to like, and selling the idea of investing to healthcare actually can drive returns and is like really interesting as a, again, diversified asset in the portfolio in this particular example. Okay, great. You got everyone on board. They're like, we love it. We're going to do healthcare. Now what? Well, I don't actually know any healthcare funds, right? So then you probably have to say, okay, well, let me do the market mapping. You go online, you do some researching. But realistically, like if you're at a good shop, an LP shop, like you probably have this miraculous phone that you can pick up and dial anyone in the world. And like everyone's going to pick up because you're an LP. So then you can leverage that, right, to run this market mapping, to call everyone in the world that is relevant to your project, in this case, like early stage healthcare. And you kind of have to, at that point, I think is the nuance.
Yeah.
Because like that could take forever. You have to have like, probably you start to like iterate in that phase of like, okay, now am I more biased towards like life sciences early stage? Or am I more biased towards like tech enabled services early stage? Or am I more biased towards like, again, like the venture versus growth, or more like software only? And then like within healthcare, there are going to be these different like theses and themes that you can make the bet on of like, okay, this is how the healthcare industry has changed, right? It's outcomes based now. So therefore, like maybe I'm just looking for people who are building their whole investment strategies around how the industry has changed. And I'm just going to talk to them. Like that's the nuanced piece where you have to have some opinion as an investor of like this is how the market is changing. These are the people that are addressing that market change. I think this market change is going to persist, and this is how value is going to be created in this market. That is your investment thesis you're starting to develop, right, within healthcare in this particular example. And then that starts to focus your time. And then you go deep and market map based on like whatever you have kind of pulled together as your like investment thesis. But I think some people, from my vantage point, like sometimes miss that part of like developing their own investment thesis, right? And they kind of do the market map, but they don't do the iteration piece.
Yeah.
And so at the end of the day, they don't actually end up with like an opinion on what makes money.
You mentioned opinion, like having an opinion on what makes money. Most, and I would say most, many LPs out there might just look like, oh, I know healthcare is going to make money. I know software is going to make money. I know AI is going to make money, but that's not an opinion. What is an example of a good opinion?
Public market comps are, 10x forward, and you have, a $3 million business and you're investing at a $5 billion valuation, right? Like, but it's a healthcare company. So you're investing into healthcare. Are you going to make money? Potentially in 30 years. But like, again, like there's some easy, like low hanging fruit of like, yeah, this deal just like doesn't make sense. Right? Like it's not going to make money. Again, I think the nuance of developing an investment thesis is what we're talking about.
Yeah.
Like the opinion there is based on your research, which is backed up by data, based on the conversations you've had, right? And again, like sometimes there's, maybe all the time, there's no right answers because no one can predict the future like consistently forever, right? So as an investor, especially a VC, you're trying your best to predict the future, right? But everything when it comes to an investment decision is like the information flows, the data, building that perspective, right? You getting to a decision, that investment decision-making process, that informed investment decision-making process to develop an opinion on like what a good bet would be. And again, if you looked at the data and said like, just those three areas I mentioned, life sciences, tech-enabled services, and software, let's say are the three buckets. And you said, hey, I'm an LP. Maybe I should invest in all three. That could be an opinion. But maybe your opinion is like, I actually think life sciences is more compelling for XYZ reasons than tech-enabled services or software because of all the research I did and the data I've seen and the references I've completed. This is my opinion. Like life sciences is going to be a more interesting part of our portfolio. than tech-enabled services and software. So like you've kind of, through your research process, like the tactical thing I just explained, you've come to now a conclusion, like an opinion on what makes money in healthcare. That makes into your portfolio. And guess what? Someone out there is probably taking the other side of that trade. And someone probably has also looked at the same market data and research reports and probably did that, market landscaping exercise, same as you. And they probably came to a different decision, right? And so like you kind of get diversity of thought across the investment landscape. Sometimes you don't, right? And that's where I think you see bubbles, where it's like people kind of look at it and say, oh yeah, this is the next internet. All the dollars have to go into this, right? Like so many people made money in the first internet. This is the second internet, and like some of that stuff becomes more like consensus thinking, like generally accepted. And then you see like a lot of dollars go into the same investment bet.
Yeah.
Right. And I think like the point here, so as not to ramble, like if the point is to be tactical, like if you're an LP, right, just at least be self-aware. Like, make sure you're forcing yourself to think for yourself, right? And not necessarily like follow the crowd, and make sure that you're coming to like your own decisions and conclusions and developing your own opinions based on like your own research, right? Because I think that's the best way to kind of like build really smart next generation investors. Like true emerging LPs, like you should think of yourself as, right, like the experiment.
Yeah.
Right? How do I get smarter? How do I make better decisions? How do I constantly improve my decision-making framework? And what are my opinions based on, right? Are they based on someone else's opinion, or is this my own opinion, right? And an opinion, I think maybe even is the wrong word because it feels like it's non-facts based.
Right.
Right? Maybe belief is a better word, or investment thesis is a better concept. But again, it's you're developing that. Like if you're the emerging LP, you should be the decision maker. Even if you're in a bigger team, even if you're not on the IC, know what you're betting on. Know whether or not like, you're a 1 or a 10 when you do the deal, right? You might not like the deal and it still gets done. You might love the deal and it doesn't get done, right? But do you know whether or not you love it? I think that's the opinion you want to try to develop.
Actually, there are a couple questions I have, and I want to throttle the Wi-Fi speed for just a sec so we can touch on a couple things you just mentioned. The first of which is what you just mentioned, which is like you may not like a deal and still do it. Obviously, if you have an investment committee of other folks who like the deal, that is the most obvious reason of why you might not like a deal, and the institution, the LP, still does it. But what are other reasons that you may not love a deal and still do it?
I don't know if I would. I don't know if I'd encourage people to do that.
Okay.
There might be in the past when I've had to do that, it's more for strategic reasons, right? Like you don't actually think there's a kind of financially oriented reason to do the investment, but there's a strategic reason to do it. And therefore like the deal gets done. But if I'm the sole decision maker, and again, like thinking about it, trying to like give advice to your audience, like the LPs, like if I'm the decision maker and, you're having gut reactions and seeing a lot of yellow flags and right, like that, whatever you're thinking of, that's probably the thing you should be spending time on with your due diligence. And if you can't get comfortable with that risk, again, I think human behavior initially, right? Like if you're an instinctive human that's become an LP, right? Like we're going very basic here, but there's probably a fear factor that's playing out, right? So like you initially see something and like the initial reaction is probably like fear. Okay, but is that warranted? Right? Maybe, right? And why? Like, is that fear based on pattern recognition? Or is that fear based on the fact that you're human and skeptical and like, this is how you've been trained as an analyst, right? To be skeptical of everything, and everything and everyone. And so, I mean, again, this is probably the self-awareness point. But I would, as an LP kind of want to know like whether that fear is warranted. Mm-hmm. And I would dig into those areas and I would spend your time on due diligence there. And if you can't actually logically, rationally, reasonably say, hey, initially I had this fear, but now I kind of have looked at the risk in 10 different ways and I'm comfortable taking that risk, right? I'm going to monitor it, but I'm comfortable taking it. I don't know if that's like you don't love the deal. I think it's more like you've honed in on the risk and managed the risk. Like, but if you don't love the deal, even after looking at all that, like, I don't know why you would do that. Like, I just think I think like the only reason you do it is if someone else on the team had more decision-making power than you and like made you do the deal. But if you're becoming your own investor, your own LP, I don't know if like you should make that deal if you don't love it. Maybe if it's like free money, it's structured in a way like you can't lose. Like it's 100% odds.
No free lunch.
Yeah. Right. Like, yeah. So again, like there's probably that where it's like I'm 100% likely to actually get, multiples of my money. I hate this deal, but it's like, right. Someone's like there and you're like, I'm going to give you $1. And they're like, well, I have this $5 bill. I'm actually going to give this $5 bill to you as soon as you give me that $1. And you don't like this person. Right. But you're like, it's guaranteed. Like you'd probably take that deal. You'd be like, well, I think I can forgive this person. I'm going to give them $1. Right. But I'm going to get $5 like immediately. Right. You probably do that deal. Like even if you didn't love the person on the other end of the table. So it's maybe like that, but that feels like, now we're in la la land. Like that's not going to happen.
I agree. And there's no single metric in isolation. You should always look at metrics or facts in conjunction with others because that will give you a better picture. Even in the reserve strategy discussion, right? If you're an emerging LP doubling down on investing in an emerging manager, you have to figure out do you want to be investing in 3 funds or do you want to be investing only in 1 fund? If only 1 fund, then maybe the strategy is like, I just need more shots on goal, right? Maybe I do co-investments after that. But if you're investing in multiple funds, you're like, okay, how does this fund become a firm? How does it become institutional? And that means, do founders let these investors on the capital repeatedly? And is there value that's provided to their portfolio repeatedly where it could warrant doubling down on their pro rata, per se?
Yeah. I mean, there's other concepts like maybe the industry you're investing into should have a reserve strategy because the follow-on capital isn't as prevalent there. Mm-hmm. And so, yeah, like if so, I would look at that as an LP and say, you don't have a reserve strategy, who are going to be your follow investors? You're going to have to invest into 2 or 3 rounds before this is even relevant to anyone else, right? Until this company has like the traction to be relevant to follow-on investors. So like as an LP, you probably want to understand again, like the industry, the investment strategy, kind of again, like the dynamics of the underlying companies and their industries to really kind of say, yeah, this is something I care about or it's something I don't care about, right? Because on the flip side, you can say like, oh, in VC, I had no reserve strategy. Wow, you're getting 10% ownership up front, but you don't have a reserve strategy in a small fund. Like then you might make the bet as like, I don't really care that you don't have to be like, and it's like these companies, you're super plugged in and these companies are demonstrating that they can raise follow-on capital and get financed. The LP would probably make the decision, you as the LP should make the decision like, hey, that's actually really interesting. Like high ownership. I don't care that you don't have a reserve strategy. I care about the fact you're getting really high ownership up front in a market where you're proving that like there's downstream financing already. That's interesting, right? Like I want you to buy up more ownership up front. So maybe that's the strategy you end up like betting on, which is like no reserves. So again, I think it depends.
Absolutely. Depends. The summary of this conversation. But nevertheless, I think the takeaway here is to have an opinion before you start making investment decisions because and have enough of a sampling size, meaning this is probably the magnitude of hundreds and not 13 kind of funds. Okay. Winter, we're in the back half here, and I don't want to cause too much whiplash for our audience, but we're going to switch topics a little bit. And so a couple things, like, just as we're coming to the close, are there any kind of things, rookie mistakes that you see emerging LPs make that you would probably give, hey, here's a warning, try not to make this mistake, or be aware of this is happening? Like, Are there any things that you would recommend emerging LPs to be looking out for?
Yeah, I think you just said one of them, right? Which was, take your time, be patient in the beginning. I know some VC firms, they hire a partner, they don't let that partner invest for at least a year, right? So you're wrapping your head around kind of the motions.
Yeah.
I think the thing about this market is, just the whole piece about like the venture market in general, but this idea of apprenticeship, right? And even if you don't work for a place like Hall Capital or Sapphire, try to find some mentors, right, that have invested, right, that can become your mentors or even peers, to really like hone your investment judgment, right? Because I think if you start out as a silo, and this is true for emerging managers as well, like and this is a debatable point, right? Because some people would argue like, oh, the solo capitalists, like it's good that they're not weighed down by anyone else, like that their decision isn't diluted by like partners. But I do think there's something to be said around like understanding the fundamentals and the apprenticeship piece of understanding the fundamentals, and like who is actually helping you with that. So because like this concept of emerging LPs, like we talked about this, I think in the coffee shop in San Francisco, it's like emerging LPs sometimes don't look like me, like almost spinning out of like really traditional institutional shops, right? Some of them are just like, they're coming to market and they're just pools of capital. They haven't trained as traditional LPs. But again, I would say, like, do you have the right, keiretsu around you that helps, inform your business you're building and inform your perspective and inform your decision making? So I don't know if that's like mistakes that have been made, but like, as I look at the market now, like there's a lot of new LPs, like potentially mistakes that could be made, if you're not building the right IC or advisory board or mentorship network. The other thing maybe is, I could go on, but maybe one more thing to think about as an emerging LP is the, like overweighting or underweighting any particular thing in the diligence process before you actually know. And so this is me projecting, but, I would used to do 45 reference calls for a particular investment. And I know that's a lot. It sounds like a lot, almost an unbelievable amount, but I would do that. I think the diminishing returns piece there was pretty great. Meaning, did I need to make more than 5 or 10 calls? Looking back, probably not. But in the moment, right, like I wanted to be very thorough. But, looking back, I don't know if to get to a better decision, you need to make, right, like you need to turn over 45 rocks.
Yeah. And
so I just think that was me overweighting the references piece, right? Like just the sheer amount of references. And especially if they're like on-sheet references versus off-sheet, right? I don't think that's a case of like my mistake overweighting. And maybe it wasn't, like it seemed to have led to some like really good decisions and some really good performance. But again, I would just think about that, more the intellectual exercise, and then like, again, how it informs kind of how you're going to act. But for me, like that was probably something where I was just like, oh, like references are really important. I got to do as many of them as possible. Or they're very important. But again, like there's, people have different agendas. Like when you kind of do references sometimes. So understanding those agendas, and like there's also like differences in like the references, like on sheet versus off sheet, and just like what do you actually learn beyond like your second call?
Yeah.
Right. And I think, that's something that as an LP, like that's just one example, but across the spectrum of doing due diligence, like are there other pieces of it as you're thinking about the investment, right? As you're doing the diligence, that you're overweighting or underweighting, and like, does it really matter, right? Like be able to answer the so what or the who cares question like pretty often.
I love it. I'm going to ask one last question before we ran out here. And the purpose of this podcast is in two parts. One, to reveal the tactics that emerging LPs can use in terms of their own process for investing in venture funds. But the flip side is also to paint the humanity behind LPs as well. And so this is a question I love asking our guests. And if it reaches a dead end, do let me know. But I'm curious. Most people in this LP landscape have a beautiful resume. I mean, come on, Winter. You were at Hall, you were at Sapphire, you started Open LP, you're at Coolwater, you wrote a book. Realistically, if anyone looks at your resume or LinkedIn, they're like, man, like Winter's done everything right in his life. He did everything right. But I've always been a fan of the antithesis, like the anti-resume of sorts, right? I have one myself that literally highlights all the biggest failures and professional mistakes I had in my career. So I'm curious, what was a time in your life, a moment, an experience, a chapter in your life where you found that you were the most punitive to yourself?
That's very, very complimentary. Like, cause I look at it differently, right? Like you mentioned it earlier in this podcast, I grew up on a farm, in what some people would call like the middle of nowhere, right? My parents did not do the traditional path to college, not go to college. My mom went back like years and years later, right? So, and then, I got lucky, like with my parents, like not really having the ability to like provide advice on like how to get into college, like to get into like a really good college. And then I didn't really have exposure to VC until really post facto grad school. Right. So I was at like a huge disadvantage from like people that like grew up in the Bay Area and kind of have just been like inculcated into this like, right. So it kind of feels like my version of the story can almost be like the antithesis. It's like that I feel like the outsider coming in, like I need to learn because like I missed the first 25 years of my life not understanding VC. Right. So I would kind of look at it, a little bit different. And if I'm, again, talking to other people out there, like, again, I didn't grow up around VC, that the idea of multi-asset class that we were talking about is kind of a lofty concept, but like the nuance between asset classes, it's a very hard thing to understand in the beginning. Like if you're just starting out as an LP, like the difference between how a hedge fund makes money versus a buyout fund versus a venture fund versus an energy fund, like, again, like, do you know the differences there? When you're just starting out, probably not, right? So you have to have this, I think, intellectual curiosity, and then this ability to try to like tap in, like what we were talking about, like when you're dipping into the Bay Area, like this curiosity, like again, be structured about it, but like tap into things that are making you smarter to make you like, what do you want to be? Do you want to be a better investor? Like everything in this conversation, I think, is really around trying to become a better investor. And some people who are LPs maybe want to be more on the manager side, right? Or more on the ops side and not the investing side, right? So again, I think, it's very complimentary what you said, but I kind of view it like, at least personally, I'm coming at it as like, man, I'm at this huge disadvantage because I didn't know about VC for like decades of my life. And now it's like, every day, how do I get smarter to really understand the space? Because it's so fascinating and so important, right? For the cause of innovation.
You know what? Like it was a different direction than I was expecting, but I love the answer nonetheless. And there's no better place to end on than the note in which you just mentioned. So as we wrap things up, Winter, you're everywhere on LinkedIn, Twitter, email. Where is the best place for people to find you? Let's say they have a reaction post this podcast and they're like, you know what? I want to reach out to Winter. I want him as my mentor. You might get way too many mentor requests, but where do people find you?
I think LinkedIn right now is the best spot. You can reach out to me, like DM me on Twitter as well, but I'm probably more frequently like scrolling LinkedIn just to stay on top of business news.
You'll have tons of, like at some point you'll be the mentor of 100 other folks or 200 other folks. Anyways, Winter, thank you so much. I enjoyed our time. So without further ado, see you around.
I've got to build out that 40-person office, so. Thanks, David. That was fun, man.
Hello, Superclusters fans. You've seen the logo at the beginning. And now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.